Hi, and welcome back to our channel, Pay Down Debt Solutions. How are you guys today? I have a great customer letter that I want to share with you guys today. It's actually a customer email, and it goes along with the point in what I'm going to be explaining today. And that is how a credit card will beat a loan every day of the week, anytime. Okay. And so we have a customer who got one of those checks in the mail, and she has a really great email to share with us. And with her permission, of course, I'm going to then read that email to you. But I want to talk to you today about something that we have been getting over and over and over again, where people call us or they email us and they say, I don't make enough. I just don't make enough money. And because I don't make enough money, I can't get myself out of debt. Well, that isn't true in 95% of the cases that we see. It just isn't true because you guys, you are payment poor, not because you don't make enough. You're payment poor because of the way the banking industry works and the way you've been taught to bank. That is the only reason why you're payment poor. Probably not because of your job. Now, could everybody use some extra cash? Of course we could. All of us could. But if I show you a different way to bank and that's going to save you money and create wealth for you in the process, I know you jump all over it because why wouldn't you? We did. So, those of you that know my story, I will go ahead and tell you one more time, just in case you're new to our channel. My name is Jen, and my husband Dan also runs videos. We created Pay Down Debt Solutions because we were in the situation that you guys all find yourself in today, where we were payment poor, we were strapped for cash, and although we were business owners, we had a really hard time with our payments, and we just felt like we weren't making enough, even though we ran successful businesses. And a little bit more about my background is that I actually come to you as an ex banker and an ex branch manager. So I do understand these products at the bank and how they work. And I can tell you that the way that I'm going to show you how to bank is not being taught by you because your bankers don't know. And let's be honest, guys, the banks are in business to make money, right? That is what they do. That is their job. They are there to make money. Your bankers are there to make money and they sell you. Believe it or not, they're selling you. Why do you think they ask you to pick a loan over a line? Because they get more incentive for a loan over any of those lines that you could choose. They get more money. And I know that because I did it myself. I know. So, a little bit about my background. Like I said, we come to you with a bunch of knowledge. I come to you with a knowledge of banking. Dan's the money guy. He's the numbers guy. He really understands numbers and he's created multiple businesses very successfully. So we do have that to kind of fall back on and let you know that we are lending you a bunch of our experience. So we also found ourselves, and I know many of you are finding yourselves in this same situation because we know that after the first of the year, the first quarter is when the most bankruptcies happen. That is when the most bankruptcies end up being put on the books. Lawyers are really busy at this time of year because right after Christmas, people find that they're in all sorts of debt and they're getting ready to do their taxes and they realize they're in a whole world of hurt. So now they've got a problem and they have to figure out what to do with it. And so Dan and I did exactly that a few Marches ago. Okay, so it was March, about 3 years ago now, and we actually consulted a bankruptcy attorney because we just weren't sure where to go. We had all these payments and we were cash poor because of it, and we didn't want to get rid of the wealth that we had accumulated. We wanted to see if there was a way we could hang on to that cash and maybe file for bankruptcy and try to get ourselves out of a situation. Well, that didn't work out for us very well, and I'll tell you what, I'm so glad that shortly after that I found Velocity Banking because had we not, we might have done something that we would regret, like a bankruptcy. Now, the other thing that I can tell you too is that we consulted with a bankruptcy attorney, and those bankruptcy attorneys, they don't know how to bank like this. So they don't offer you solutions because they don't have any. And granted, they are in business to make money, right? They are in business to be in business. And so they do need to make money as well. And so even if they did know how to bank this way, they might not tell you about it. They might not. I can't say all of them would, but we're all in business to make money, right? That's what we're here to do, is to get ourselves out of debt. And, we need to have a job. We need to go to a job every day. And so can't be mad at them, just like we can't be mad at our bankers, right? They're doing a job. Banks are doing a job, but they're making a whole lot of money off of our back. And so while we need the banks, right? While we need those tools that the banks provide us, it is up to us to learn how to use those tools properly because these guys aren't, the bankers and the banks are not teaching us how to do that. Okay. And so it isn't your fault that the banks are, in a sense, stealing your wealth from you, but it is your fault if you do not learn a different way and you do not learn how to get out of the traditional banking system, because that is what is keeping you payment poor, guaranteed 100%, because that is what was dragging us down until we found velocity banking. So my job is to teach you a better way of banking. And I'm going to show you once again, because you guys all love the picture graph, I'm going to show you again what velocity banking versus the traditional banking and loans are going to do for you in a customer scenario. Now, we hear all the time, I'm in debt because I don't make enough money to get myself out of debt. And the answer to that is it's false. Because most of the time, okay, and in 95% of the cases, like I said previously, you find yourself in a situation based on the way you're doing your banking and not because you don't make enough money, okay? 95% of the cases, just rearranging your money just a little bit can make all the difference in the world for you. And I'm going to show you that too today. Now, the less than 5%, so it's less than 5% of people we help, that it has been the case. So, a lot of times what happens is people that change their jobs, so maybe they have a high paying job and they have to change jobs, they get fired, they get let go, the company downsizes, something like that, and then they end up making less money. Yeah, in that case, sometimes people then are caught in a situation where they are making less and they need to make more. Now, and there's plenty of you out there that have side hustles, and you're going to work every day, and then you have side hustles and you're trying to make extra money, and that's awesome, so long as it's not taking you from your family ridiculously. Because you know what, guys, family first. Family should always come first. And so if I can teach you how to rearrange your money so that you can spend more time with family and less time working your side hustles, then that for me means all of everything. Because I'll tell you what, my family is incredibly important to me, and I want to spend my time with them, not working 24/7. Okay. Love what I do, but I still need time for family, and that is my priority, as it should be with you as well. Okay. All right. So the traditional banking methods steal your wealth. And what do I mean by that? Why do I say that the traditional banking steal your wealth? Well, the thing is, you just don't see it because you've been taught that you go to work, you get a paycheck, you put that paycheck in your checking account, you pay all your bills, and then if you have a little bit left over, you're going to stick that in savings. And then while you're at work, you're going to participate in a 401k, and that money is then going to build for you in the background, which is great. And that's a fantastic thing to do, and you should contribute to that, or at least do your matching, but don't do more than that, especially if you're in debt. If you're not in debt, by all means, hammer money in there. That is up to you. But if you're in debt, scale back on that, and yet let's use your funds a little bit more wisely. Okay. Use them wisely. I did a video on that not too long ago about an individual who, when he backed off of his contributions that he totally forgot about, right? He was banking, and he was going to work, and he had set up his 401k, and he put his contribution amount, and then he totally forgot about it. Well, their matching was, I think, 5%, is 5 or 6%, and he was putting in 20%. So when he peeled back that 14-ish% and started using that toward his debts, he flipped himself from a negative to a positive in just that one move alone. And that helped him get out of debt quickly. Okay. So think about where your money is going. You have to think about that, and you have to rearrange what you're doing with your money. Okay. Because you're not seeing this. When you traditionally bank, you're not seeing what's happening to you. And I'm about to show you a different way. Okay, so what you need to learn is how to use the tools at the bank as well, right? So I was a banker. I was taught the tools at the bank. I was taught what they all were. I was taught, interest rates, and I was taught the percentages of your credit card and the loans and the lines. And then we had this commission schedule, right? So we had a sheet of paper that listed all of the products on there, what our commissions were as a banker. So when we sold one of those products, we were going to get a commission. And guess what? The highest commissions were paid out on. Just guess. I guess you guys that know me don't even have to guess. You already know. Loans. Loans got us the highest commission, and checking accounts as well. Okay, loans and checking accounts. Highest commission on those. And that is because, number one, the loans, even though they sell them as a lower interest rate, okay, because all of the loans are amortized, and that interest is then front loaded, you are paying that interest up front before you pay anything else, balance is included, right? You pay the interest up front and you're paying minimal amounts to the actual balance of the loan. Okay. Whereas a line of credit is calculated on an average daily balance. So whatever that line is at on an average day per that statement cycle, that average is what your interest rate is actually calculated on. So when you make chunk payments to that line of credit, your interest does what? Yeah, it drops, right? So that's why the average daily balance and simple interest is so beautiful, okay? And not only that, lines of credit are open. So what does that mean, Jen? What is an open-ended loan? Or well, it's not a loan, it's a line, right? When it's open, that means you can charge it up and you can pay it off and you can charge it up and you can pay it off, and you cannot do that with a loan. So once you make your car payment, you put that money in there, it's gone, right? It's completely wiped out. It is no longer available to you. And because it's gone, if you have an emergency and you have no cash flow or you're upside down, you're in a real conundrum, especially if you don't have any lines of credit to work with, okay? And you don't have a savings account, which we know more and more and more Americans do not, because we are getting ourselves in tighter and tighter and tighter, and costs are going up, which means we're spending more a different way. And that's what I'm going to teach you today, is how to think outside the box. If you're here and you're learning, that means you're in a situation where you want to learn to use your money more wisely, right? And that's what I'm going to do for you today. So the first thing when we enter the pay down strategy is to look at all of our bills. Number one, we organize them. We organize all of our bills, we take a look at them, and we restructure things, okay? So organize everything, know every penny coming in, know every dollar going out. So we first organize. The next thing we do is we are going to identify. We identify our debt destroyer, okay, which is always a line of credit, always a line, never a loan. A loan will not help you out, but a line will. So you're going to identify that debt weapon, that debt destroyer, and we're going to use that then in whatever strategy we choose to then pay down our debts. And we're going to do it in double time than what that loan schedule that you're on is going to have you getting out of, okay? So the last stage obviously is implement, and then we implement that plan, and that's how you get yourself out quickly. Now, I want you guys to stop falling for loans. I hear it, I see it all happening, and I saw it today in the email of this customer that I want to, share with you today. And I'm really proud of her. This is like just such an incredible situation. So let me grab that email and read it to you. Okay, so again, these checks in the loan, right? So here we have Linda. Jen and Dan, I hope this finds you well. I want to thank you for providing such incredible information. I only wish I found your channel sooner. Thought you might like this situation I found myself in this past November. I had to purchase a car since mine literally died on me. I had $4,000 in the bank and had to use a check in the mail that I received to make up the difference. I didn't have a single credit card because Dave Ramsey said I couldn't seem to handle them well. My mistake. What you will find interesting is that I did the Dave Ramsey strategy 6 years ago. I had called into his program and he told me to cut up my credit cards and close them out, which I did. I pinched my pennies, as you say, and after 5.5 years, finally got out of debt. This past year, I got some profit sharing from work, $4,000, and left it in the bank. No credit card or line of credit for backup. The check was a mistake. Since finding your channel, I have now moved that loan into a credit card and will be out of it faster than I imagined. Thank you so much to those out there wondering if they can do this. You can, and I wish I had done it sooner. Have a wonderful day and Happy New Year, Linda. So thank you, Linda. I appreciate the email, and we did chat back and forth a bit with Linda, and so I want to kind of go over the scenario that we have for her. So here we are, right? And you guys, I'm not knocking Dave. I'm just telling you that for me, when I tried the Dave Ramsey strategy, I actually felt more hopeless and not better, because I felt like everything I was working for was being flushed away into all of these debts. And I felt guilty and I felt terrible. I felt like a bad person because I was in this debt and I had to get myself out, and I felt strapped. My kids were feeling strapped. And it was just, it's not a fun position to be in. It's awful. And so, while he's helped a ton of people, what happens is there are tools at the bank that he does not like, such as credit cards, okay? And so he tells people to cut them off and get rid of them and don't ever get another credit card because they can't handle it. Well, I think you're smarter than that because I'm smarter than that, right? So I think you're smarter than that. And I think that if you're in debt and you see the light at the end of the tunnel and you find a way, and that way is simpler than you thought, and you free up cash flow for yourself, I know that you're not going to get yourself in that situation again. Plus, they're amazing backup tools, and that is what Linda found, and she needed one and didn't have it. So she was scrambling. So she ends up grabbing one of the checks in the mail and uses it. And let's get into that. Let me show you what that looked like for her. And I'm so glad she found this channel, and I'm so glad she got herself out because it changed, it changes things for you. And so, you know what, Linda, I wish you would have found us earlier, but we weren't out there then. So anyway, let's get into her scenario here. So stop being a victim of the bank, number one. Don't be a victim anymore. Number two, cash this check, right? So we see these checks in the mail and we've seen a flood of them starting in November, right? They start pumping these checks out and people, they're feeling desperate. They want to have a good Christmas. They want to have a good holiday, or maybe they need to pay for a car like Linda did. And she was in a scenario or a situation where she had to, do something fast. And so she did it. And then you find out the details, or the details and you can't do anything about it anyway because you're feeling stressed because we aren't prepared, right? So these credit cards can help prepare you, okay? And I know you guys are maxed out. I know a lot of you are. We have the max card strategy, so go look at that. No matter what, you can still run your banking this way. Even if you're maxed, it isn't going to matter. The only difference is the micro payments that you need to make back to the card instead of a one-time payment. I want you guys hitting that card every other day with payments. Divide them up, right? Divide up what your income is that you can put on that card, your chargeable income. I'm sorry, the income left out, after your non-chargeables. You put that income in and make sure that you're putting it on that card every other day until you know how that card is going to react. Because I do not want to see those cards lowered on you, and that would put you in a world of hurt. So please don't do that. Just micro pay every other day until you see how that card's going to react. Then slowly build up the amounts that you put back on that card. Okay. So she got a check for $6,200. It was a check loan for $6,200, okay? And her income is $4,450. Her total expenses are $4,160, which leaves her with a cash flow of $290. So that's pretty decent. Now, granted, we know that, if things come up, as they always do, that might leave her a little tight. But you know what? If she's been banking that a little bit and she's had months where she hasn't spent as much, then maybe she has a little bit of a cushion here. But if not, we know that one bad expense can wipe that out. And a lot of times that happens monthly. Okay. So she has a mortgage that she's paying $1,050 on. That is her mortgage rate. And she cashed a check in the loan. And we know she did this because her car crapped out on her and she had to get a new car. And so she used partial funds from her profit sharing and then the partial from this check that she got. So this loan check here was 31.99% when she cashed it, which is astronomical, right? It's sick. So it was 31.99%. And that's what makes me so mad about these checks in the mail, because they know you're vulnerable, they know you're going to cash it, and they make a lot of money on it, and they don't care what it does to you, and that's not fair, okay? So her new expenses then are $4,160 plus the $2,447, because this payment is $2,447. I'm sorry, 247. I don't know where I got that from. So 247 is her payment now, right? So that means her new cash flow is now $43. So she went from 290 cash flow to $43 because she needed to buy this car, okay? Now, she then realized what she had done, right? She realized what she had done, and she, watched our channel, right? So she only did this for a couple months, started watching our channel, and then realized she should have done something different, okay? So then what she did is she went out and got herself a credit card. Now, in full disclosure here, she did get a credit card and she used the 0%. But I'm going to show you, even if she used the interest rate that after the 0% goes to, which is 21%, how she still comes out ahead, okay? And I've graphed that out for you. So her new cash flow, like I said, is $43. She has a credit card. It's Bank of America. It's at 21%. And she got a line there on that card for $6,800. Now, remember, with Velocity Banking, we're paycheck parking. So we're going to paycheck park all of our available income then onto that credit card. Okay. Now, what's available? The available is everything that is chargeable. Okay. So she has expenses that she cannot charge through a credit card, such as her mortgage. Okay. Not the car, because she owned her car outright and then she bought a car outright. So her mortgage in this case has to be then held out of her income, as well as it has to be held out of her expenses, because she cannot pay that through a credit card. Now, in full disclosure, yeah, she could pay it through Plastique, but don't do that if it's a monthly reoccurring. Just do it for the one time. If you're going to make a one-time big, move over to a card or a one-time big purchase, do it once. Do not do it monthly, because you just end up adding a percentage, right? If it's 3% to do Plastique, you've now made your card, instead of 21%, 24%, right? So don't do that if you can avoid it. All right, so now she has this card, right? And she decided, she only needed about, she needed the 6,200 because that's what her check was for. So we take the 6,200 and we do our convenience check fee charge, which was 3% here, which that is the charge that she was charged with, 3%. So that means she has to add $186 onto that 62. So we start our balance with 63.86. That is her starting amount with that convenience check fee in there. Now, what velocity banking teaches us that's different than traditional banking is this. You are going to put all of your paycheck into that line of credit, like I just said, holding out what we cannot charge. That money then that you put in, that deposit, lowers it by a chunk, right? Because we're making a chunk payment. In this case, it's $3,400. We're making a chunk payment to that card, which drops our average daily balance and drops our balance and also drops our average daily balance. All right. And so now what happens is she doesn't actually owe this payment, right? She doesn't owe the $247, because that payment then comes back to her as cash flow. So she doesn't owe it anymore. All right. Now, when she does the traditional loan, she does owe that. And it isn't absolved because she's not working her paycheck through anything like a loan. She's just not working it through the loan. So in that case, right, then she isn't able to work it down like we're going to work it down here. All right. So now she has a $43 cash flow here, and here she has still $290, right? Minus the interest of this credit card. Now, how do we figure the interest of the credit card? Because we have to do that. In her case, when she did this, it was zero, right? She used the 0% cash advanced check, and so it was 0%. But here, I'm showing you this at 21%, so we have to calculate our interest. So here's how we do that. Because it's on an average daily balance, remember, we take our high balance, we take our low balance. We add them together and we divide them by 2 to get our average. We then take that number and we multiply it by, so we're going to multiply it by, right, 0.21, because it's 21%. So we multiply it by 0.21 and we take that number, and that number then is divided by 12 to give us the 82. Okay. So if I take my calculator, and you guys can all do this with me, if I take 6386 plus 2986, it equals 6672. We divide it by 2, and it equals 3336. And then I'm going to multiply that by 0.21, and then I'm going to divide that by 12, and that gives me their interest rate. Okay. So now we have our interest rate here. We have our expenses, right? Because remember, our expenses, we have to hold out that mortgage. And in this case, we know we don't have to worry about the 247, because we're just working it through our checking account, or we're working it through our credit card like a checking account. Okay. So that checking account is useless to us at this point, other than to pay that mortgage. Now, again, for those of you out there running a maxed card, you have to remember, you got to hold that money, your paycheck, into your checking account and you have to micro pay every other day, because if you make a big payment, they're liable to drop your credit, and you don't want them, or I'm sorry, your credit limit, and you don't want them to do that. Okay. You want to keep your limit as is so you can continue to work this way. And then you just watch it, and eventually you can increase that every single month. Okay. So it's a little more labor intensive when you have maxed cards, but you guys can do this. Once you get used to it, it's like second nature. It's no big deal. All right. So here we have our interest rate. We get our first month then, right? All right, so we have our month. So if you take a look at the 6386, you minus the 3400, which is our income, minus our mortgage, we end up with 2986. Then we have our expenses. Remember, we have to take our mortgage out of our expenses as well, okay? Plus our interest gives us 6168. Now, I am showing you here with the velocity graph, okay, our high payment, right? That is our high amount. It's the 6386. And here's our 82, which is our interest. And then this is our low, the 2986. This is the low. So remember, you got your high, you got your low, and we're averaging that out, okay? And that is how this works, okay? So you can see it step down as we go, right? Okay, so then you go to the next month. We've got 6178. Here's your 6178. And then our low is 2778, 2778 right here. And then our interest rate is the 78 right here. Now, so those of you that are new, I color coordinate this for you. So your expenses are in blue, your interest is in green, and your income there is in purple, okay? All right, so now we're moving on. So we have now 5966 is where we're at. So it's gone back up to 5966. We then have our expenses and our income, our expenses come out, our interest comes out, and we're down to 5750. So 5750 is the next point that we're at. And then we have our income come in again, and then we get our next balance, and then we have our expenses and our interest come in, and so on and so forth, which drops us. It continues to go. Now, I did run out of board here, so it does go on for another 4 months because it takes this woman, right? It takes her 13 months, so 1.1 years to get out of the debt that she just incurred for herself using the velocity way. But when she left it on this loan schedule, and you guys, oh my gosh, I think I missed a income deposit, didn't I? I did. These numbers are right though, because I did run them for you on the side. So sorry about that. Man, I guess I'm just like rushing or something today. Anyway, so when she does her traditional loan, right? So when she let this loan, if she were to let this loan schedule run out, it's going to take her, look at all this. This is the micro steps, right? Because your interest is all front loaded. So she's paying the majority of her interest up front and less in balance, right? She's paying less in balance, more in income because of the design of these loans, all right? Because they want to get their money up front, and they're going to get their money up front, plus an origination fee. Let's not forget about that too. Okay, so now when she does it this way, okay, it's going to take her, and I'm going to reveal this for you. So we're going to see the difference here. And I apologize if I'm off camera. Hopefully it will have saved okay. All right, so if she lets this run the traditional banking way, right, it's going to take her 42 months, so 3.5 years, and she's going to spend $4,179 in interest, which is a killer, okay? For $6,200, she's paying $4,179. Think about that. That is why we say the banks are stealing your wealth, okay? Because if she leaves it on the schedule that it's at here, right, and does it the velocity banking way, she will have spent at a 21% interest rate. 21 is more than most loans, right? Most loans, the incentive is that they give you this loan for really inexpensive, right? Like maybe 8%, 7%. And you're looking at your credit cards at 21, 24, 30%. And you're thinking, oh my gosh, that loan is so much better. But it's not. Not if you do it this way, not if you bank the way that we're suggesting you bank, okay? So it takes her 13 months, 1.1 year, and she pays back $757 in interest. But we all know, because I told you, that she got a 0% card, right? So guess what she paid? She paid zero interest. The only thing she paid was that a convenience check fee for $186. So think about that. So she paid $186 to use $6,200 of financing, right? And that's exactly what she did. So now, after conversing with her back and forth in the email, and thank you again, Linda, I really appreciate the email and I appreciate the praise. We do. It means a lot to us. But now she has a backup line of credit because she was told that, you know what, you can't handle credit cards. You need to cut those up and never use them again. So she took that advice and she did that. But you know what? You guys aren't going to do that again because you know what situation you were in and you're not going to want to go there again. because this is the light at the end of the tunnel for you. And that is why velocity banking is so powerful. I can't tell you enough how important it was for Dan and I to find velocity banking and how much it changed our lives. We didn't end up filing for bankruptcy, and we came out in a great position. And now we're creating companies like this, and Dan can focus on the things that he is more that he is exceptional at, I should say, such as our platform that he built for you guys. I cannot wait for it to come out. We've been using it. It's been great. It's beta testing, super amazing, and this makes your life so much easier. It will make it so much easier. Thank you guys I hope you've learned something today. I hope you're continuing to learn. Please continue to send us emails with questions, comments, whatever. I appreciate that. And I am not perfect, so sorry about the math over here, but it all works out the same, and it all runs down the same. And we know that the answer is velocity banking over your traditional banking every day of the week. And stop using your checking account. Use a line of credit and do yourself a favor. Get yourself out of debt. Be debt free for 2025. Thank you. I hope you guys continue to like us and subscribe. The more you like, the more this content gets out to people out there. And we are in this together. Let's work together to get us out of debt. Let's make America amazing, right? Let's get let's have those bankruptcy rates fall and have success rate and happiness, all of that go up, because you deserve that just like we did. Have a great day, guys. Hope to see you soon.